Hey guys, hope you are all having a fantastic weekend so far. Keep in mind that tomorrow the markets will be closed, and because of that I have decided to delay the typical Sunday video for tomorrow. That does not mean, however, that the core of those type of videos will be ignored today. We are going to be talking markets today, jumping from one topic to the next because right now, everything is chaos. I thought we ended Friday's trading session relatively weak with a sell-off, but it was after the markets closed at night that bad news saturated the market, imposing a really bad impression of things to come, and that has led to a ton of fear. Everyone is screaming market dips, and already we have seen the crypto market retesting the lowest points it had previously held a couple of weeks ago. As such, I believe what awaits us this week is a ton of volatility and dipping. I think we are at a point where the only thing that is going to ease the tensions of investors right now is if one side of the Ukraine and Russian conflict decide to back down. President Biden said he believed a Russian attack to be imminent, and unless he backtracks or Russia does indeed start sending troops home, we are in for shock and awe in the markets. On top of that, we are nearing March, and the feared rate hikes are looming, and it is weighing heavier and heavier on investors. I think we are going to see serious sell-offs this week, and if crypto is any indicator of what is to come, you better buckle up and brace yourself. Things are about to get really nasty. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive right in. First and foremost, we need to talk about war, and more importantly, how markets tend to react and shift to them. I've been reading articles posted by experts who have studied the relationship between armed conflict and the effect they have on portfolios, and I want to share everything I learned, so please stick around because this is crucially necessary to understand right now. Markets have been volatile for months, fluctuating uncontrollably. Market hikes, inflation rising, and now, Ukraine on the brink of war. With Ukraine being a bigger factor than the other two combined, it seems that daily news is what is driving the markets up or down. When Russia said they would begin withdrawing troops, the markets rallied. When they didn't, the markets went back down. When news said more troops arrived at the border, markets fell, and now with the White House saying a war is imminent and that they are confident something will happen, next week appears to be the most brutal week we will have so far. Let's address the geopolitical crises and their impact to a theoretical well-balanced portfolio. During Pearl Harbor, S&P 500 fell 11%. When Germany invaded in 1939, S&P 500 fell 25.8%. During the oil crisis of 1973, S&P 500 fell more than 17%. Looking at the conflicts and other notable ones, S&P 500 stays around 6.5% in a negative territory for about 3 months after an armed conflict erupts, and the bounces back up around 13% positive in the following 12 months after said conflict. Now, these were major conflicts and events, none which I have any reason to believe that are comparable to what will happen with Ukraine. I certainly don't think World War III will happen out of this. Instead, let's compare current events to the Vietnam War, the Gulf Wars, and the Soviet invasion of Afghanistan. During the Vietnam War and the Gulf Wars, these conflicts brought very short-lived drops which were followed by a very bullish rally shortly afterwards. Russian invasion of Afghanistan in 1979 only brought a 12-day index drop of 3.8% in total. And even when Russia took over Crimea in 2014, there was only a 2% drop. These examples are way more accurate in giving us perspective for what to expect because, frankly speaking, the implication of what will happen with Ukraine will not have long-term ramifications in the index development. With ample and grounded facts to keep us in perspective moving forward, we arrive at a fundamental question: what do we do now? Well, like I said, because the implications of an armed conflict don't seem to have a serious impact on the economic fundamentals of the United States, I think this means that investors should be fairly aggressive in buying. From the beginning of World War II to its very end, the Dow Jones was up more than 50%, and the stock market in general grew a monster 115%. This is not the time to be scared and to be conservative with your purse. This is the time to be aggressive. Again, the reason for this is that from a historical point of view, the rally always supersedes whatever losses the markets get short term, and from a fundamental point of view, American economy has little exposure to Russia and Ukraine and whatever scenario might come out of a conflict, even if it happens. I think the biggest issue will be computer microchips and Europe's dependence on energy from Russia, but these things will solve themselves out. Remember, Russia cannot afford to not have Europe as a customer unless Putin is seeking to destroy his empire, which is already a shadow of its former self and is already falling apart as well. Russia, over the years, has had less and less leverage in the world, and as Western society continues to evolve their renewable energy sources to become less dependent on finite sources like oil, crude-dependent economies will become desperate and struggle to survive. But for now, they need customers, and because of this is why I think nothing huge will come out of this. And this is one of the points in the video where I need you to pay very close attention to the following information. The biggest real cause for market volatility is uncertainty. You can have a terrible set of events happen, but if everything is set in stone, economists and analysts can simply plug in the numbers and develop rally plans. In fact, this is so true that if you grab a chart, you will see that during wars, stock markets actually tend to be less volatile than any other times, which is quite ironic. You could have a war unleashed, but once that happens, everything stabilizes. It's the fear of uncertainty, the fear of what others might do, that makes things unpredictable, and the more dramatic it is, the harder it is to predict the future, which is why we get market volatility. I guarantee you that if a war was to outbreak next week, by the end of March, we will begin a rally that will set stocks on an upward path again. Historical data proves this every single time. So again, if war begins this week, I personally am selling everything I can, even my body, to get as much money as possible because I am going on a shopping spree. Get your shopping list out because I honestly cannot find a single data point to make me nervous of what might happen. A war erupts and we will quickly dip only to rally. If a war doesn't happen, and instead we just live through a suspenseful couple of weeks or months, it means prices will begin stabilizing and going up until a war breaks out, which sends us dipping before a relatively quick bounce, or troops get sent back home and the rally intensifies. I am not asking you to believe me if you have no trust, I am telling you to go look at the data, open up the S&P 500 and Dow Jones historical graphs and tell me I am wrong. Look at the US stock market exposure to Europe and Russia and you will see we don't really have anything to worry about. We need to be bullish and aggressive right now while everyone else is scared. You can diversify your portfolio buying other stocks and you will most likely see a great return on investment. Right now, not only are meme stocks super cheap, but Microsoft and Apple. If you are scared of what might happen to GameStop or AMC, you can buy some blue chip stock or major index and wait for it to rally and then put those profits somewhere else if you decide to sell. So, as you can see, I am bullish on the market from the conflict angle of what might or might not happen in Ukraine, but like I said, it isn't the only thing waiting in the stock market. We have Fed rate hikes coming up in a couple of weeks, and we need to be ready. The Fed is, in my opinion, the only actor that makes me nervous, because their mismanagement with inflation has caused markets to be what they currently are. The Fed has no more room to mess up, they have no leeway. If they aren't intuitive enough to start raising rates that punch inflation out, we could see a market crash. But if they punch too hard, they can easily spill the pot and send us crashing down just as easy. They have to hit the mark perfectly. Now, if you have been watching my videos for a long time, especially the morning ones, you will know that the Fed works to satisfy and protect Wall Street. It's almost like they only care about protecting the markets from overall economic retracements and conflicts. I think they will get these Fed rate hikes correct. It is my opinion that after the first and second rate hike, if the Fed doesn't send us down into a market crash, markets will become confident of their ability to take care of business, and we will no longer see as much volatility due to them reflected on the market in months to come. Again, what is causing volatility in the markets in relation to rate hikes is the uncertainty of what they might do. Once they start getting them right, investors will be more confident and prices will stabilize. And with all of this in mind, let me say this. For months, investors have been crying left and right about prices for stocks being too high. That GameStop was too expensive and that AMC wasn't as affordable as they wanted them to be. We are now at the perfect point where assets are all discounted at large margins, where there is little risk in purchasing a stock and not see a return on investment. This is not the time to be scared, or to begin trying to time the market perfectly to get the absolute bottom, because you won't. Before you know it, the markets will rally and you will have missed out on the best discount, so don't be a fool and arrogant enough to think yourself the best at timing the markets. Buy in small paced chunks, get a nice little average at the bottom and enjoy the ride up. All this analysis has been done by countless hours of research I have done. Again, I won't act like I am the Nostradamus of stocks. The stock market could crash and we could see asset valuation fall as much as 72% by account of some of the more bearish analysts and experts. It's important to stay and maintain a well-balanced mindset in all of this. Based on the data I saw, I am more bullish than bearish. This is a market correction and not a crash, but that is my own opinion. You are more than welcome to disagree, and I encourage you to do your own research and come up with your own conclusions. Let me know in the comments what you think of the video and come join my Discord for more market discussions. Thank you for watching my video to its end. If you want to support this channel, links are below for PayPal and Cash App for one-time donations, and my Patreon is there if you really want to spoil me. Enjoy the rest of your day and to the moon.